Welcome to part 5th of the video, and in this we would be covering about KPMG Hedge Accounting Manual, and I would be taking you through the example of the fair value hedge. Now what is that example? It's a live example which I'm taking. Suppose Cognizant India, why suppose Cognizant is having a subsidiary in India, but that works on intercompany model, which means that the actual work is done by Cognizant US, but actual contract is signed by Cognizant US, but the work is done by Cognizant India on behalf of Cognizant US, which effectively means that Cognizant India will get compensated by the parent company Cognizant US. So ultimately, the billing is done by or the invoice is raised by the US entity while the work is done by the Indian entity. So, which precisely means as a client. So, today, Microsoft assuming giving some work to Cognizant. So, they would be signing a contract with the parent company known as Cognizant US, or probably non-parent company also. It may be Cognizant European, Cognizant London, or maybe any other country. But the contract is with them. They will not sign the contract. They will not, this entity who is signing the contract, assuming Cognizant US, they are only signing the contract. They are not doing the work because the cost of doing the work is extremely high. Henceforth, they don't do the work. They delegate or offshore the work to the Indian entity because here it is cheap, relatively much cheaper if Cognizant will get the same work done in US. Now, the invoice entity would be Cognizant US, while the work entity would be Cognizant India. So Microsoft would be facing two counterparties. One is the invoice counterparty, billing counterparty, who is Cognizant US. One is the work counterparty if the work is not up to the mark or there are any changes in the processes or anything, pricing, COLA clause, cost of living adjustment, and many things. This will to the Cognizant India. Now we need to understand very importantly that Cognizant India needs to be reimbursed under the arm length transaction, which is also known as intercompany model by Cognizant US. But that funding won't be INR. That funding would be in dollars, probably GBP, probably euro, probably Swiss franc, probably Canadian dollar, probably any other currency, which all I mentioned dollar, GBP, euro, Swiss franc, Australian dollar, Singapore dollar, Canadian dollar, all these currencies are non functional currencies for Cognizant India, which creates an impact known as revaluation at the end of the month. Now, sometimes this revaluation is positive, sometimes it is not positive. And when it is not positive, it impacts the P&L, preferably speaking EPS, which is earning per share. Now, to hedge this exposure, Cognizant India is having two ways. Either they can hedge in the deliverable market, which means they hedge that revaluation exposure. I repeat, revaluation exposure, not the translation, sitting in India, or they hedge this to the global treasury center. Like I said, it is always advisable to hedge this at global treasury centers, which includes United States, Luxembourg, Frankfurt, London, who by the way is losing fast, Singapore, who is also losing fast, Hong Kong, Dubai, and many. But in terms of Asia, Singapore is still the preference because Hong Kong lost it completely because of their political disruptions and now COVID 19. So Hong Kong lost it completely. Let it be honest. Now, if you are hedging this in the global treasury centers, which I mentioned, you will get super premium. Don't go with the word super premium. You will get the premium which is beyond expectation because the kind of liquidity. It is like suppose you hedge this exposure in Singapore. I will come give you more detail. Then you will get a lot of liquidity. Because suppose you held hedge with anyone, JP Morgan, Citi, Standard Chartered, Goldman Sachs, Barclays, UBS, almost everyone you have in Singapore, almost everyone. And they will offer you the fair value hedging products. This includes non deliverable forwards, this includes non deliverable options, this includes non deliverable OIS, non deliverable FRA, forward rate agreement, and many. All these non deliverable products have different nomenclature, which I am not covering in detail. I have already covered on my YouTube channel. You refer the video. But here, which is the guide by KPMG, did you knew or did you got to know about anything which I mentioned? And I'm at page number 9 of this guide. You would never got to know. And this suggests that how technical is the hedge accounting manuals of KPMG. How technical is the hedge accounting manual of KPMG? Millions of companies worldwide follow this blindly. Chartered accountants follow this blindly. CPA follow this blindly. Some extent CFA, not charter, certified financial analyst follow this blindly. But are these manuals 100% correct? 100% technical in nature? I doubt that. They are not 100% correct. They are not 100% technical in nature. Henceforth, we need to agree to one thing, that the hedge accounting which is done based on these manuals is flawed. And history is witness that there are audit deficiencies done by all big fours. Whether this is EY, this is KPMG, this is Deloitte, or any other big four. The deficiencies is not restricted only to KPMG. Eventually, I would be bringing a lot of such videos in that regards. But having said that, in the next part, I would be covering about the mark-to-market piece of the fair value hedging. And you would be surprised to know that here you will again get an error by KPMG. Till now, we are at page number 10. And you would be happy that the intercompany exposure, which I discussed with you, the deliverable markets, which I discussed with you, the non-deliverable markets, which I discussed with you, to hedge in deliverable and non-deliverable market both, which I discussed with you, is completely missed in this guide. It's completely missed in this guide. This is how exactly these guides work. And I'm always surprised. If there are people from KPMG who will feel offended, let it be honest, who will feel offended because now their hedge accounting manuals are under scrutiny, they can give me a call. By the way, I hope you are reviewing the KPMG on the Google. about their latest scandal in the audit. So, guys, I will repeat and let's move to part number 6 then. The largest scandal in the world is not the LIBOR scandal. It is not at all the LIBOR manipulation. Let it be honest. The largest scandal in the world in terms of money, which is still going on, let it be honest, is the mark to market accounting. Because 99% people of the globe, I repeat, 99% people of the globe do not understand mark to market accounting. Since they do not understand mark to market accounting, whatever they see in the financial statements, they feel it correct. Like if I give you the annual report, which is 10K of Amazon consolidated, who have many business streams, many companies and different kind of models, and I ask you to check the hedge accounting of Amazon, it won't be possible for 99.99% of the people because it is highly complicated. What about if I ask you Google, Goldman Sachs, who is the bank? Because Amazon is not trading. They are hedger. But Goldman Sachs is trader and hedger both. JP Morgan Chase, Citi, it would be very complicated, which means so would be the hedge accounting. So if I ask you to check the hedge accounting of Goldman Sachs, you will really feel very, very complicated in that regards. But if you look at these manuals, you will feel like what the hell these manuals are talking. See you in the part 6, wherein we would be covering a very interesting thing known as hedging instrument and hedged item. See you in the part 6.